Hey everybody, in our last Red Friday video, I briefly talked about how to decide if a HELOC was the right loan for you. Well, today I want to go over that topic in just a bit more detail by pitting it against the VA cash out refinance so that you can better decide which option is the best choice for you in 2022. Now you'll notice I'm wearing red because it's Friday. Every single Friday I wear red. All the employees here wear red. I try to get my wife and my kids to wear red, and I want you to wear red too because red stands for remember everyone deployed, and that's what we stand for here at Low VA Rates. We love and support our military men and women. So do it. Speaking of red, down there in the bottom right corner of your screen you will see subscribe, like, follow, something to that extent. Do it so that you can be very educated and always up to speed on what's happening in the mortgage world because it changes often. Now to get started, let's look at some of the pros. That's by pros, you guys know what I mean, like why you should get a HELOC. I want to go into this, right? Pros of a HELOC. Number one, HELOCs are an open line of credit that you can pull from as needed, okay? A lot of people like that. It's a line of credit. A lot different than just a one lump sum loan. That's kind of boring, right? Line of credit sounds cool. This means that you don't pay interest on any of the untapped funds that you're using. So instead of going out and borrowing $50,000 and then spending that over the next 5, 6, 7 years as you need it, you're wasting a ton of interest by borrowing money that you do not yet need. Also, lower costs, okay? Lower costs. And when I'm talking costs, I'm talking closing costs, right? Sometimes there's not even any closing costs, but they're generally lower. If you already have a low interest rate on your primary mortgage, what do I mean by primary mortgage? Your VA first mortgage, your FHA mortgage, your conventional mortgage, the mortgage you use to get your house. If you already have a low interest rate on that, well, then getting a HELOC does not impact that, okay? So no impact on what I refer to as your first mortgage. It does not impact that at all. Now, your initial monthly payments during the draw period are going to be lower. Why? Because normally speaking, during the draw period, you're in an interest-only payment. We're not going to get into too much of that right now, but just know, huge benefit. Now, the amount of money that you can borrow can be replenished by repaying back the principal during your draw period. We've talked about that in a little summary video that I've done before, but you can always replenish the amount of money that you have access to by paying down your balance. Just going to put those first three up there. Now I want to look at the pros of a, and by the way, these were HELOC pros, right? Now we're going to look at VA. I don't know what's going on here? Okay. VA cash out. Here are some of the pros. Pro number one, money comes as a single large lump sum, which is beneficial if you're going to be using it to cover some big expenses all at once. Okay, so lump sum of money when we're talking about the VA cash out. You can use this cash that you take out to pay your closing costs if you want. You can basically use it for whatever you want. Now, remember, the VA cash out replaces your original mortgage or your first mortgage. Why is that important? I'm going to put it right here. One payment, because you only have one mortgage. A lot of people like that. They like simplified finances. Okay? Monthly payments are going to be much more consistent and easier to budget for on this loan, especially if you get a fixed rate. You don't have to, but almost everybody does. It's a fixed rate mortgage. One payment, fixed rate, way easier to budget, way less stress. This up here, not only is it almost never a lump sum, but I forgot to put it because I was talking about the pros. Keep in mind, that's normally not a fixed rate mortgage. So if you choose an adjustable rate cash out option, then your monthly payments will still remain fixed for a specific period of time, normally 3 to 5 years if you get your hybrid ARM loan here at Low VA Rates. Now, these loans for veterans are easier to qualify for than HELOCs. I think that's important to put. Now you might say, Eric, you've got more pros than you do for the HELOCs. Just so happens to be. Each person's individual situation will determine whether or not the HELOC is more advantageous than the VA cash out. And don't forget, I had more pros, I just did not put them up there. Here, in my opinion, is the single biggest pro. So I'm going to actually make this so important. I'm going to erase all of this. The single biggest reason that the VA cash out loan is amazing and its biggest pro is 100% LTV. You can borrow 100% of your home's equity. There's not another loan out there that I'm aware of right now on a refinance where you can use the cash for whatever you want, where you can borrow 100% of the equity in your home. Okay? So now I want to talk about some of the cons of each of these loans. And I got into some of them because I have the tendency to go down rabbit holes. Ask my wife, she calls me squirrel all the time. I'm chasing squirrels around. So I'm going to try to stay focused here. We're going to talk about the cons, right? We're talking about cons right now. I put that up there to remind myself. I'm going to talk about the cons. First, we're going to get into HELOC cons, okay? HELOC, well, riskier. They are a riskier loan, okay? Which means they normally have higher rates and more strict qualification requirements, okay? That's what's going to happen. I'm not going to write that there. You guys should know by now. You're all experts from watching these low variance videos. When you've got risk, you've got higher rates, you've got more strict underwriting requirements. And listen, we've talked about interest rates going up in 2022. They may continue to go up in 2023. That makes the HELOC potentially a little bit riskier than some want to have. Now, in addition, HELOC rates can adjust more often. Sometimes they adjust every 6 weeks. Sometimes they adjust monthly, but lots of rate movement. Interest rates move, your interest rates move on the HELOC, your payment moves. So the repayment period of the HELOC can cause payment shock for some people, and that might cause financial difficulties since the payment amount may have the tendency to increase more than what you're ready for, and that could be a problem. Now, your lender, if they so choose, could potentially come in early and close your line of credit at any time if the housing market starts to tank, right? If home values start dropping, which some think they may start doing more and more rapidly, there is a chance that before you draw out all of that equity that you want, the bank says, this is too risky for us, we're going to make some changes. Now, you can repay your principal during the draw period. However, some lenders may also charge prepayment penalties. I use that prepayment penalty really lightly because after the housing collapse of like 2007, 2008, whenever that was, prepayment penalties have kind of been something that most lenders have steered clear from, but they are starting to come back. So I'm going to put it there. Just make sure you look when you're getting information on your HELOC whether or not there are prepayment penalties. Now, since the HELOC is a separate instrument, if you will, financial instrument, than your mortgage, you're going to have to make and manage 2 separate monthly mortgage payments. That might not sound like that big of a deal, but you do not ever want to miss making a payment on your HELOC. It is considered a mortgage because it's attached to your home. Your home is the collateral, and that can destroy your credit. So just be careful. You're going to have 2 mortgage payments. HELOCs also, here's a con, they have a maximum LTV. We've talked about CLTV, but you guys know what an LTV is. Maximum LTV almost always at 85%. Some lenders may stretch that a little bit higher, but that's not nearly as good as, remember, some of the pros when we were talking about that. That is the con of the HELOC. You can't access all of the equity in your home. Okay? Now let's talk about some of the cons on the, I'm going to try to finish the video from this side. VA cash out. We'll see how this goes. So on VA cash out loans, you're going to have upfront closing costs that are significantly higher than your HELOC. So I'm going to put higher closing costs on the VA cash out. If you already have a low interest rate on your current mortgage, VA, let's just say, because you can't do a VA cash out loan. Well, that's not true. You can be a veteran that does not have a VA loan. So let's just say on your current first mortgage, your interest rate's down in the 2s, which most people have if they got their home in 2020 or 2021. When you do a cash out refinance, you're going to replace that lower rate with a higher rate, assuming the market is higher, which it is right now. So lose potentially low rate on your first mortgage. Don't know if you guys can see that. I don't even know if I'm in the camera, out of the camera or not, but you could potentially lose your low rate. There's also a good chance it's going to restart the term of your mortgage all over again. You could choose to do a 25-year, VA cash out loan. Most people go back to a 30-year and it starts that whole prepayment period over again. Now, since it's a one-time lump sum payment when you pull out VA cash out, you may not be able to use it in emergency situations because you spent it all up front. You paid off those credit cards, you paid off that car, and you took that vacation, you accessed all of your equity, and then 2 years later something comes up, unlike the HELOC where you could then go draw more money, assuming you have the equity left. You can't do that without doing a brand new VA cash out all over again. So, with the pros and the cons of both the HELOC and the VA cash out in mind, let's talk about how you might determine which one's right for you. So to start, let's try and figure out how you plan to use the money you're pulling out of your home's equity. If you want to use it to consolidate high interest rate debts, for example, a single lump sum payment via cash out is probably the best fit for you. But if you have smaller amounts that you want to access periodically over time, you want to create a safety net for financial emergencies, just have it there in case, then a HELOC might be better for you. I got a true story about that. I've got a buddy, he has pretty much a very small balance on his mortgage. And we were talking the other day because he knows I'm a mortgage guy. He knows that his home value is at an all-time high here in Utah. He's got some plans as his kids get older in the next 5, 6, 7 years that he wants to have some money for. But he doesn't need it right now. And I told him this exact same thing. Go get a home equity line of credit. Go get a HELOC. You don't need to do anything with it other than have it in place. And then when those needs arise, you can go tap into it. So just kind of a real life story that I was just having this conversation the other day. If you struggle with your spending, right, then a HELOC with its revolving credit line could have you spending more money than you can really afford. So be careful. Just because it's a safer bet than a credit card, if you're the type of person that just spends on your credit cards all the time because they're there, don't go out and get a HELOC if you don't have any specific plans or needs for it. It could be dangerous. However, if having a big influx of cash all at once would tempt you to spend it unnecessarily, then a HELOC might be better, like I was talking to you about with my buddy. When you need it, it's there. So just seriously, pause. Think about your current situation. What does your monthly cash flow look like? If your budget is tight right now, having a second mortgage in the form of a HELOC might stretch it even thinner if you're not careful. It might be easier to manage a single payment, which in that case, a VA cash out refinance would be the right choice. So what you got to do is you got to think about your future. Sit down, plan. If you're married, if you're dating, whatever, get somebody else's opinion involved and try to determine if a HELOC payment is better or if a VA cash out payment is better for you. All right? Because again, on a HELOC, you've got your HELOC payment and you've got your first mortgage payment, yet on a VA cash out, you've got one payment. Those are just a lot of things that you might want to consider. Okay? Also, what are your finances at right now? If your credit score is below 700, if your DTI ratio is pretty high, well, you might not qualify for a HELOC. Might have to look into a VA cash out. You're also going to want to think about interest rates. Okay, what do they look like? What do they look like right now? And what direction are they trending in? Now, in 2022, we are definitely in a rising interest rate market. I personally feel like we're going to continue to be in a rising rate market for this foreseeable future. So HELOCs, which are almost always variable, that could mean that your interest rate on what you're borrowing could start rising every month or two, and in turn, your payment goes up. However, if you choose a VA cash out refinance, you're going to be able to lock in your current interest rate, and that's never going to rise. Now, I just talked about how we're in a market where interest rates are going up, but they're still historically really low. What I love about the VA cash out refinance also, go ahead and lock in a rate today that might be higher than your current interest rate. It's not going to stay there forever because the Fed will have to reverse course at some point, and when the Fed starts cutting rates, you're going to come back to low VA rates for a streamlined refinance, and we're going to bring that interest rate back down as far as we can. Okay? So, if you have any other questions, well, before I get to any other questions, let me go back to what the original question really was. What's better for you, a home equity line of credit, HELOC, or a VA cash out? For me, the simple answer, yes, I'm biased. I love VA loans. I love the VA cash out refinance. For me, this right here, guys, gals, whoever you are, VA cash out is the clear winner, even in this market where rates seem like they're going to continue to go up. Number one, with rates adjusting higher and higher, you're going to want to lock it in soon, and you're going to want to shop, and you're going to want to at least look at low VA rates because, as our name says, we want to help you get a very low interest rate whenever possible. And because of the current inflationary situation in our country, your money is not going to go nearly as far as it has been, and it might continue to get worse. So having just one mortgage payment is going to help protect your budgeting and your cash flow. I like the VA cash out more times than I don't over the HELOC. Now, as I close up this video, I just want to reiterate that even though I personally think the VA cash out loan is the best option for you, or it's the better option for most people in 2022, it doesn't mean it's the best option for every single person, okay, 100% of the time. So if you want to talk this over, if you want to get into your specific situation, I promise you we've got loan officers standing by. They'll be happy to help. All you got to do is pick up that phone, give us a ring. If you don't like talking on the phone or you're busy at work, we can live chat, we can text. You can simply inquire on our website, and we'll get back to you when it's the most convenient. Thanks for watching.